Hello, hello, hello. We have a real treat for you today. It's an interview with Rod David. And Rod, the floor is yours.
Thank you very much, Jeff. I appreciate it. Thanks for having me back on. And just as a reminder, I am having an open house this week, which is a live stream, simulcast live stream. This is the VidiTrade Vidi room that we're looking at right now. This is going to be simulcast for non-members. Just drop in at the VidiTrade YouTube channel. It's youtube.com/@VidiTrade. And you can just jump right in and you can see all morning Wednesday and Thursday. I think I had Tuesday and Wednesday in the save the date, but we're going to have to do Wednesday, Thursday, which will be fun because Wednesday is FOMC or Wednesday, FOMC afternoon. I'll probably extend the exposure into the afternoon so that Jeff, your followers can see how the signals catch setups and capture turning points on an FOMC afternoon. And then Thursday morning, there's usually a lot of good activity too. So Wednesday and Thursday this week is an open house. And meanwhile, I just want to show what it is that we do, what you'll be seeing when you come. And this is basically a 1 minute chart on the right of E-mini, and S&P 500 E-mini, and a 3 minute chart on the left. The thicker red and green lines on the left, these are my bias parameters. This is a separate system that I'll allude to if you become a member. It's something worth digging into for sure. But these levels are identified before that window. So as of Friday's close, these levels were identified, and you can see how they capture price action. As of noon, these levels are identified. They didn't exactly capture price action, but there are rules as to how and when they're actually disposed of that can be predictive. And I'm going to explain how these were predictive this afternoon. But that's a point to make about VidiTrade. It's not just price, but timing. We've got two vectors. You know, you hear a trap or a false break, and that's all interesting when you know the price, of course. But how do you know when it's actually a false break or when a breakout is actually broken out? And that's when you apply the cross-section of the window. The timing window. So it's not enough to just probe a price. It has to be maintained or rejected by a certain time, and then we can infer all sorts of behaviors from that. So I'll show for an example today. Today we entered the session having rallied Friday. I'm sure everybody recalls just a face-ripping rally intraday. Started by gapping up, trended up, but ended back at prior highs. So Friday's buyers gained no traction for that effort in my book. It doesn't mean they can't extend higher coming out of the weekend, but there's a method that buyers have to follow if they're going to do that. They have to begin when there's no traction gained through the prior close. If they intend to continue controlling the narrative or the next window, they're going to have to begin by gapping open beyond that prior window's extreme, which they did. So we had that indication through the open. There's another indication. This is all day trading, all intraday market timing. There's the overnight high where my cursor is. What was that, 5701? And if the intraday is going to at least be in a position of strength, then the first 15 minutes, that's a window. You can see that our windows are listed below the screen here. The first 15 is a handoff from the overnight to the intraday. If the first 15 minutes can exceed the overnight, that's another vote of strength, another degree of reliability that buyers are taking control. And they did that. They did that to such a great degree, though, that information, this position of strength as of 9:45, having gapped up above the prior highs, having exited the first 15 above the overnight high, to then have that great insight as of 9:45 that buyers are in a position of strength was totally useless because they'd already played it out. They'd already been so impatient that they were rewarded. But this is where the bias comes in. This is a bias up. The bias up signal, new window, 10:15. Here's the bias window was entered above the bias up signal. In fact, it was entered above the bias up target, renewing the bias up. Still that great insight, still not immediately applicable, but it does give us context to know that if sellers are going to control or seemingly influence that window, not only bias up, renewed bias up. Number one, being a bias up window, if tested, the bias up signal should hold as support or define the low, and it did. But if sellers are basically, this is the interpretation of price dropping, sellers are influencing the window, that's really at the whim of strong-handed buyers. So we knew all the way down, I continued in the video room, just stressing patience. Toward the end of the morning, we took a couple stabs at longs. They didn't really work out until the bias window had totally lapsed. So we've got that position of strength. First 15 lapses above the overnight high. The bias up is renewed because at 10:15, the bias up target's being exceeded. We've got the gap up above above Friday's highs. So we know there's a higher high coming. But when and from where? And in this case, sellers got to expend all this selling pressure in a window, a bias up window, when they're not going to gain traction for that effort. Buyers were being patient. So it's not just, price doesn't fluctuate just because sellers are dominating. It could be because buyers in this case were stepping back and letting them have the rope to hang themselves. So we came into the end here of the bias window, and this formed another setup called alternation rule. The alternation rule steps in when the morning bias has discernible patterns, and it did. Plenty of discernible patterns. Here's the 1 minute chart again, and there's levels. Here's buy and sell signals. Not very productive, but discernible, calculable levels. And throughout the morning, definitely kept developing, but didn't extend. There's the initial first 15 minutes. What did the rest of the morning do? Nothing compared to that. It was all noise in the range. That's where the alternation rule steps in and says, expect trending. Now, not in either direction. It just so happens we had a position of strength, so we expected the trending to start or to be attracted to the upside. And when we've got all of those not necessarily aligned, but at least pointing in the same direction, that's a reason to take greater exposure. If you trade one unit, trade two. To accept greater risk, if you have just arbitrarily a 3-point stop, consider 5 points. And to look at pullbacks as opportunities to add, we've got a tactic that I teach called the 3x3. These red lines are pullback limits, so that once they're pierced by at least 3 ticks, we start a 3-minute countdown. Once those 3 minutes have elapsed, basically being the usual attention span of weak-handed counter-trend sponsorship, once it has run its course, the trend often will extend, not because it's any likelier to. It's not a great buy because the trend is any likelier to extend, but because it's so close to where we'd know it's wrong to be long. You know, if you can buy at the stop or just above your stop, that's something you would do all day long, not even knowing what the rate of return is, what the likelihood is of extending in the direction. Because if you've got a valid system, then you've just got to play the odds, and that's the odds. And that played out really well, obviously. Today, there were some other bells and whistles here, but I just wanted to point out that's how the system works. Then we also look at some bigger picture stuff, So we want to know the context of where we're at, and just to leave everyone with some sense of what the analysis is projecting. Of course, we've had this huge decline, very lengthy, and by everyone here, I'm sure, is sophisticated enough to know we don't know where the low is, or the bottom at least. We do expect, even if this were 100% assured to be a protracted, extended bear market, that there's going to be bounces along the way. We certainly want to be positioned for those if we can. We're traders. But, and then also just the normal, or that's the wrong word, but the average of a wide array, but average length of a leg. This is multiple weeks. I mean, at some point, sellers are done. At least they're resting. So it's certainly worth looking for a bottom. We're taking as credible any bottoming attempt. It just has to live up to certain standards, like it has to recover a prior high. Friday's rally didn't do that, so color me a little skeptical. Today's rally seemed to, but it's delayed. Why is it delayed? Well, we'll see. I'm still a little skeptical as far as whether this is a durable bottom. Notice that the downtrend remained intact all the way throughout. Every lower low, every stretch was an ongoing series of lower lows and lower highs, lower closes in a lot of cases. The pauses never recovered above a prior high. The downtrend remained intact and was exploited. So we had a pause on Friday. It's been exploited today. I've still got resistance above since Friday's rally failed to gain traction. Again, held the prior high that it tested. It didn't have to test prior highs. It did, and failed to close above. So that means the next higher recovery, or the next opportunity to recover anything predictive, where Friday stopped short. Today stopped short as well. There's nothing being recovered today that was encountered. No prior high that was encountered. We already encountered these prior highs on Friday and failed to recover them. So now another prior high has to be recovered in order to indicate a durable recovery is underway. It's a lot of play. I mean, I'm not suggesting don't trade to the upside. But even if we knew with 100% certainty this intended to resolve down, here's a corrective bounce. The next candidate I have for a recovery is another setup that VidiTrade has, and that's called the proxy gap. So here's prior Friday, cash session closed. In other words, when the cash session was closing, where was ES trading? It was 58.30. So 58.30's cash session close created a gap when Monday opened down to 44.50. We're trading into that open today. But if we take 58.30, this will be ballpark, pretty close, down to 44.50. You know, they say gaps are always filled. Walter Deemer, in fact, high-profile, old-school technician, he says gaps are always filled. And maybe back to closes, that is. I've found, not with any great regularity, but the proxy gaps tend to always be filled. The proxy for that gap is the 61.8 retracement between the close and the open that created that gap. So I do expect at some point that 57.97 is going to be met. And as long as this will have taken, I suppose, to recover, if it does, why not go ahead and fill that gap? And if we do fill that gap, another VidiTrade rule is gaps are filled in pairs. So if we're going to fill this gap, we're probably also going to fill this gap. That's 5,900. So there's room for a pretty big bounce if, in fact, this is a bounce, if it's not rejected tomorrow. If it's not rejected tomorrow by closing under today's lows, preferably back under and into and under some relevant level, like any of these timing windows through tomorrow's close, any of these timing windows that subdivide Friday's afternoon. So long as tomorrow can withstand that kind of downside pressure, then this bounce has room and momentum to continue up to 57.98, 58.30, even 5900, and to still be a corrective bounce. So bigger picture, just to cut to the chase on that, I'm not in the camp that says that a big correction has ended and now we're off to the races. I'm not dismissing that potential, but here's the barriers. But meanwhile, I'm positioned to the upside until disproved, again, by rejecting today's rally deeply enough, in which case we head back to the lows and lower. But that's my current outlook, which is interesting intraday. It's informative, or at least it gives us the context, but we're mostly market timing intraday and taking on trades. Here I can show real quickly the March chart. This is March ES. So we've got signals identified from Friday. And you can see how getting a grip on the open can catch some bigger legs. Again, pullback limit. This is when the pullback limits are tested. That's when the 3x3 tactic, if you're following that, says add or get back in, and can help to participate in more substantial moves. Sometimes we catch, or sometimes we catch, but we will catch the bigger moves. It's just a matter of where the entry is. But when they develop, they can be very profitable, especially when in this case, bounce limit. Pullback limit is red, bounce limit in green, especially when the 3x3 tells you the usual attention span of weak handed counter trend sponsorship has run its course. Time to place a bet that the trend's going to resume. Not because it's any likelier to, just because it's so much closer to where we know it's wrong. Therefore, take those positions that are so close to the stop. I'll do that all day long if I could, knowing that my system is likelier to produce profitable moves than unprofitable, so long as I can take a small stop and have exposure to the trend resuming. The 3x3 tactic is pretty profitable. But stop in on Wednesday and Thursday at the YouTube channel. So it's youtube.com/@VidiTrade. And if you go ahead there and get over there now and follow, then you'll get a notification when I open it up for the 7 a.m. strategy planner session, which we record. If you're there, I'll pop the recordings link in the chat. And the 9:15 pre-open update, again, recorded. But if you're there, it's a lot easier to follow the trades as they develop and the context. Right now, for instance, we're looking for a retracement down to 57.19. That was the bias up signal that was broken prematurely. Just a likelihood, not a requirement because of some other features, but a likelihood that it's going to be retraced. You don't know that unless you stop in, so I hope you stop in. Jeff, any questions about that or anything I can clarify?
No, I think that's terrific. Of course, with anyone, you have your own terminology. I think people who watch you on Wednesday and Thursday are going to get more accustomed to the terms that you use. But that's true for any analyst. You know, I have all kinds of things that people got used to me, but the first time they tune in, they wonder what I'm talking about. So that's not unusual at all. Rob,
It,
that's
it, helps,
absolutely terrific. It's
it
great
helps.
stuff.
It helps to stay unique. I think that way we don't get run over by the mainstream misinterpretations.
Well, you have a lot of your own unique indicators. You're very consistent, and that's one of the things I like. So thank you for this video, and I'm going to post this very soon, and I hope people tune in to watch you on Wednesday and Thursday of this week.
Thank you.